Hello everybody and welcome to this session of topical issues in financial reporting. My name is Stephanie Henshaw and I'm a partner at PKF Francis Clark and the firm's Head of Audit. So in this session, I'm going to cover three topics. First of all, the proposed changes to FRS 102. Now, the revisions to FRS 102 are not in force yet, so the objective of this session is to highlight some specific things that you might like to think about, things that will help you identify sooner rather than later whether you need to take action. Our second topic is about reporting estimation uncertainty in your financial statements. We're still in a fairly challenging economic environment and with many finance teams needing to make estimates on uncertain items. So this will just be a quick reminder on the factors to consider in how you present and explain those estimates in your financial statements. And finally, we're going to talk briefly about sustainability reporting. This is becoming an increasing issue for businesses of all size. So this is just a brief look at understanding and meeting your stakeholder expectations. So first of all, the proposed changes to FRS 102. Now, these are contained within the exposure draft, FRED 82, which was open for comment until the end of April. The declared intention of the FRC thus far is to issue a final version of the standard towards the end of this year. Typically, they do this just before Christmas, in case we get bored on Boxing Day, I suppose. But it will depend on the feedback that comes out of the exposure process. So it could be later than the end of this year if there are some unexpected bumps in the road. Now, based on what we know at the moment, the FRC's current plan is for the revisions for FRS 102 to apply to periods beginning on or after the 1st of January 2025. Now, that means that the first financial years reporting under the revised rules will report at the 31st of December 2025. So audits of those financial statements will be taking place during 2026. Now, that probably sounds like quite a long way away, best part of 3 years. So that's probably making you think that you've got plenty of time. But of course, you need to think about the impact of the changes on your financial statements. What will it do to your reported profit, to your net assets? And how will that impact on the figures you report under the existing regime at the 31st of December 2024, which will be your comparatives? You'll also know from the original implementation of FRS 102 that then it was actually the beginning of the comparative year that was the transition date for changes. Now, while there appear to be different rules proposed under FRED 82, there are good commercial reasons for understanding what the future impact will be. So we'll talk about those headlines, but my purpose here really is to say that you don't want to wait until 2026 to think about this. Now, before we go any further, I just wanted a quick reminder about the Economic Crime and Corporate Transparency Bill, which is currently going through the House of Lords. It's at the committee stage. Now, this legislation has some wide-reaching changes to the arrangements at Companies House. But one area that is worth bearing in mind is that there's going to be some changes to the filing requirements for small companies. In particular, small companies will no longer have an exemption from filing their profit and loss account. Now, we don't know exactly when that's going to come into force, but it's likely to be sometime within the next 12 months or so. So this is just a reminder for you to look out for that over the next few months. So coming back to the proposed changes in FRS 102, there are two big headline areas of change. First of all, leases. Following the principles in the international standard, IFRS 16, all leases will be brought onto the balance sheet. Similarly, following IFRS 15, there will also be the introduction of a new revenue recognition model, and that will be consistent with the international rules. Now, both of those are very big, chunky standards internationally, and so there have been some considerable simplifications to the text to reflect them within the exposure draft. Two other areas to mention the FRC is planning to expand the disclosure requirements for small companies. Post-Brexit, we are no longer bound by the limited disclosures for small companies in EU legislation. So the FRC has reinstated some requirements that it considers necessary to give a true and fair view. Now, again, those are not going to come in until 2026. But if you add to that the impact of having to file your profit and loss account at Companies House, it does mean there'll be quite a lot more information on public record for small companies going forward. Finally, there are numerous small amendments and clarifications in the exposure draft, which we won't go into today. So for this session, we're going to look at those two big areas of change, leases and revenue recognition. High level, but designed to give you a starting point for considering the impact on your business. So let's take leases first of all. The proposed change is to bring all the leases onto your balance sheet. So this is going to be important to any business who's got lots of items on operating lease, or particularly property, which tends to be held on operating lease where the numbers are quite big. So the left-hand side of the slide in front of you shows you the accounting implications of those changes. So essentially, to bring your lease on balance sheet, you will recognise a new right of use asset and a corresponding lease liability. Similarly, in your profit and loss account, you will bring in a new expense, depreciation on right of use asset, and a new interest cost, the interest on the lease. Now that's going to replace the rental charge, which you currently recognise for your operating lease assets. So broadly, that's the debits and credits: debit right of use asset, credit lease liability, debit P&L with depreciation and lease interest. On the right-hand side, we've got the potential commercial consequences of those changes. Now, first of all, let's think about EBITDA. Neither depreciation nor interest on leases forms part of EBITDA, whereas rental payments do. So you can expect your EBITDA to be positively impacted by the change. So how are you going to communicate that to readers of your financial statements? On the other hand, recognising a lease liability on your balance sheet is going to impact the perception of your borrowing and therefore your gearing. So that will look worse because you've got more borrowing. So again, there's a communication point. Now, depending on the definitions in your covenant documentation, these changes may also impact on the extent to which you're able to meet your covenant tests. Now, that will depend what your covenant documentation says about changes to UK GAAP and how those manifest in your covenant tests. For example, if your accounting EBITDA goes up because of the changes, are you able to report a better EBITDA-based covenant metric, or do you have to then effectively back out those changes and revert to the original methodology that you've been using up until now? It also means you need to think about negotiating new covenants. So if you're looking at bringing in new borrowings late 2023 into 2024, which are going to be impacted once the new rules apply, how do you want those covenant tests to work? Again, this is partly about whether you're then going to have to reverse your statutory accounting for covenant compliance purposes, or whether you can simply swap over. It's also worth noticing if you've got a bonus scheme that's driven off EBITDA, you may also want to consider how that operates. Is it reasonable that individuals receive a bigger bonus simply because the accounting rules have changed the way a profit calculation works? Similarly, share schemes which feed off profit-related metrics may also be impacted. Now, an important question to ask is what counts as a lease? And there's a new definition in the exposure draft. It now treats leases as follows. So a lease is a contract or part of a contract that conveys the right to use an asset, called the underlying asset, for a period of time in exchange for consideration. So you notice it's a more generic definition because it's not making the separation between finance and operating leases. That all disappears. But it's also worth referencing or recognizing that reference to part of a contract. Under IFRS, this is termed an embedded lease. And essentially, it's recognising that you might have a wider contractual arrangement which includes a lease within it. For example, a service agreement for the provision of, well, let's say catering services, but which include within them effectively the lease of ovens or fridges or other important equipment. Now, more generally, for most companies who have operating leases at the moment, we're going to be talking about big bits of perhaps manufacturing kit, vehicles, property, but also lots and lots of small items as well. So let's think about the practical implementation or implications of these arrangements. Don't have a single repository for all their lease documentation. So do you know the details of yours? And why does that matter? Well, there are a couple of practical expedients which might limit the pain, if you like, of applying a new set of rules for accounting for leases. First of all, if you've got short-term leases, items that expire within 12 months, you're not obliged to apply the new rules to those. And that's leases where the whole term is less than 12 months. But you also won't have to apply these rules to low value underlying assets. So that is things like mobile phones and computers. And there's a list in FRED 82 of what they would expect would fall within the low value category and what wouldn't. The other point to think about is how you're going to determine the lease liability, because that lease liability in turn is going to determine the starting point for the value of your right of use asset. Now, under IFRS 16, you have to use the company's incremental borrowing rate. And there have been quite a lot of practical difficulties for companies in obtaining that. FRED 82 proposes an alternative of the company's obtainable borrowing rate, which implies that you would need to talk to the bank to get a rate for an equivalent amount of borrowing. So you need to consider in advance how you're going to determine the obtainable borrowing rate, because that is going to then impact the discount rate you apply to your lease obligation, and in turn that will give you your lease liability and your right of use asset. So there are some issues to manage there. Now, moving on to the other main area, revenue recognition. Essentially what we're talking about here is turnover, although it could include other items of revenue as well. Now, currently, the rules we've got in FRS 102 are relatively limited, although they were a big improvement on what we had prior to FRS 102. There are three broad categories of revenue: sale of goods, supply of services, and construction contracts. And construction contracts, of course, is anything that would have fallen under the old style long-term work in progress. It doesn't literally just mean construction. Now, there are some advantages with the existing rules in FRS 102. They're very flexible, but it also means that they're open to interpretation. And you can get quite different interpretations for broadly similar situations. They're also not very good for dealing with complex arrangements, as there isn't a lot of structure there. So FRED 82 proposes a 5-step model as applied in IFRS 15. That sounds complicated, and we'll have a look at that in a moment. But essentially, what this boils down to is you'll still be recognising revenue either at a point in time or over a period of time. The question is whether what you are doing at the moment will be the same under the 5-step model. Now, for some businesses, it will change absolutely nothing. But for others, it will result in different reporting points for revenue. And of course, that means different reporting of profit. So again, there are potential knock-ons for the impact on financial covenant compliance, bonus calculations, share scheme triggers, profit you report to funders, private equity investors, but also if you're looking to sell or buy, a change in reporting of revenue may fall into an earn-out period. So another good reason for looking at these rules now would be to see whether actually you're going to be impacted by that change in a future period. So let's have a look at the 5-step model. First of all, you have to identify your contract. And then you need to identify the promises in the contract. Now, the promises essentially are what the company's undertaken to do for the customer. So is it a provision of services, a supply of goods, or is it a mix of both? And your contract might involve several elements. For example, the supply of a piece of kit plus its installation and its maintenance and servicing. Now, you have to consider whether each of those promises is distinct. In other words, can the customer benefit from them without any of the other elements? So things like software, telecoms, construction, support services, pharmaceuticals, they could all have different promises within a single contract. Once you've identified the promises, then you need to determine your transaction price and allocate that transaction price between the various promises or obligations to the customer. Now, you may very well find that this is quite an iterative process, that once you get to the point of allocating the transaction price, you'll then need to go back and reconsider the promises to make sure you've captured everything. Once you've been around that sort of stages 2, 3, and 4 loop a couple of times, then you'll be able to move on to stage 5 and recognize the revenue. So again, let's think about the practicalities for this. Key thing is to get a sense of the likely extent of the impact, and that's going to be driven by how your business operates. So how straightforward are your contracts? Do you have a simple template model that are applied to all cases with no variation for a simple supply? In which case, the process will be quite straightforward, and it may very well not change how you recognize revenue at the moment. Or do you have bespoke contracts or tailored contracts for each customer, perhaps with multiple promises in them, or in some instances where you're going to need to do a lot more analysis? So that kind of gives you a feel for the magnitude of the potential issue. But a further question might be is who negotiates and agrees contracts? Does that all sit within control of the finance team, or is that dealt with by a sales team? And if that's done by a sales team who perhaps have a fairly free hand, how do you make sure that the information about the different contract terms that they've negotiated gets passed back to finance so you can do the analysis for revenue recognition purposes? And of course, a further area of complexity could be within individual contracts. So have you got multiple elements where you've got to consider whether or not they're distinct? Have you got modification clauses within your contracts, and how will those work? Do you have variable consideration, perhaps built in on the basis of usage or volumes? So there could be quite a lot to think about. And therefore, some early stage analysis and planning of how you're going to implement this is advisable. Now, that's all I'm going to say about FRS 102 for the time being, but I think it's just worth spending a bit of time going and having a looking at that exposure draft and getting an understanding of what that might mean for your business. Now, let's move on. Reporting estimation uncertainty. Most businesses have some element of estimation uncertainty. It's not always significant. It might be part of routine accounting activity. For example, calculating useful lives for depreciation purposes on your regular fleet of vehicles, where you've got standard rates that you apply. It might be quite straightforward. But it can entail a lot of judgment with no clear-cut single amount that's the right answer. So, for example, issues around provisions, impairment, both of goodwill and of cost of investment, and also allocation of things like consideration and fair values when you've done an acquisition. Now, our focus today is on thinking about how you report the estimates you've made. So let's start with a look at the disclosure requirements in FRS 102. Currently, the standard says an entity shall disclose in the notes information about the key assumptions concerning the future and other key sources of estimation uncertainty at the reporting date that have a significant risk of causing a material adjustment to the carrying amount of assets and liabilities within the next financial year. And in respect to those assets and liabilities, the note shall include details of their nature and their carrying amount as at the end of the reporting period. Now, it's just worth making the point, first of all, the disclosure requirements under UK GAAP are a bit different from those under IFRS. UK GAAP is only asking us to disclose which assets and liabilities are impacted by significant estimates and how much is attributed to those assets or liabilities themselves. Whereas under IFRS, you actually have to explain the extent of variability in your estimate. So we don't have to talk about the detail of how the estimate might vary. We focus on the asset or liability that's impacted. But what do we need to say about our estimates? Well, first of all, the key assumptions concerning the future. So, for example, where you're doing your going concern assessment, what factors have you taken into account there? Anything, in fact, which relies on future performance, you need to explain the basis on which you've judged that future performance and what sensitivity analysis you've undertaken to look at potential variability. When we're looking at key sources of estimation uncertainty, these would be big ticket estimates, almost certainly not routine things. Now, they may be the same year on year, but you may get variation. For example, you may suddenly have a big variation in dilapidations at the end of a lease, or you may have a big risk of estimation uncertainty if the performance of one of your subsidiaries plummets and you've got some goodwill attributed to that. Now, we're only interested in explaining the ones that have a significant risk of causing a material adjustment. So again, this means thinking about the extent of the sensitivity to change and the probability of various outcomes. And that's what needs to get built into your disclosure. And then we're looking at things that could change within the next financial year. So it's not looking at things that might be impacted by changes going forward several years, but the most immediate changes. Now, when we're looking at estimation considerations, I think it's important just to draw a distinction about the sort of the role of management and the role of the auditors. Because a key area of discussion between management and auditors is going to be the quantum of the estimate. Now, as management, you're responsible for selecting the figure that will appear in the financial statement. So in the end, you need to make a point estimate. You need to determine a quantifiable amount. It's not the auditor's job to do the calculation. We can't make the estimate. We can't undertake the sensitivity analysis if that's what's required, because these are your financial statements. And as auditors, we have to remain independent of management. What we do is consider whether your estimate falls within an acceptable range. So we look at perhaps the best and worst case scenarios, but we'll do our own calculations for that. And if our range of calculations suggests something very different to what you've come up with, then we'll come back to you to talk that through. We'll also look at all your estimates to see whether your point estimate tends to fall always at one end of the range of the possible estimates. So if you are always picking the lowest figure or always picking the highest figure, expect your auditors to challenge that, because that may be an indication of perhaps unconsciously management bias in the making of the estimates. I said we can't do the estimation. We've had a number of cases where actually the key area of estimation has been around impairment reviews, where management perhaps haven't done a particularly thorough impairment review, especially forgetting to look at value in use as well as perhaps fair value on disposal of the relevant asset. Now, as auditors, we may do some value in use calculations ourselves as part of our range of estimates, but that's not a substitute for management doing those calculations themselves. Now, we know that judgments and estimates are not an easy area to deal with. Last year, the Financial Reporting Council did a thematic review on the topic of judgments and estimates. And I thought it would be useful to just share the table from that thematic review, because the top most disclosed estimates might surprise you, or they might not, depending on your perspective. But impairment reviews was very much the main area where there was good disclosure given, because that's where the most sensitivity occurred. There's also a lot around pension assets and liabilities, and of course that is where you have a defined benefit pension scheme because of the actuarial assumptions involved. And purchase price allocation is a very subjective area as well. I do like the fact that the fourth one is called other provisions. There's a wealth of detail hidden in there, but particularly that's going to be things around dilapidations, around potential legal provisions, warranties, things of that sort. You'll notice that items like inventory provisions feature very much lower down on the list in terms of disclosure, which suggests they tend not to be particularly subjective. So something to think about there in terms of the quality of your communication, but also whether you've actually focused in appropriately on the right items as your significant areas of estimation. So finally, I'm going to talk a bit about sustainability reporting. You may have heard quite a lot about investors and banks asking about companies' sustainability policies, the ESG. You might be seeing this from your customers wanting to know about your sustainability credentials because you're part of their supply line. You might be seeing that in terms of banks offering green finance for particular initiatives. So there's a real demand to hear about what your business is doing, and therefore an opportunity to set your business apart. Now, it's worth saying that the financial reporting regulations haven't necessarily caught up with all of this yet. We have some disclosure requirements for the very largest listed entities around the non-financial and sustainability disclosures. But you've got to be a listed entity, full listed, and with more than 500 employees, or a large company with more than 500 employees and turnover over 500 million to be caught by those requirements. So otherwise, the only reporting that kind of fits into the sustainability carbon related would be your energy savings and opportunity scheme reporting to the Environment Agency, or the streamlined energy and carbon reporting that goes into directors' reports for large companies. The thing is, if you're tendering for work and you're telling the story of the great things your business is doing from a sustainability point of view, you want your accounts to back that up. You can't really afford to say nothing just because there's no statutory obligation on you to say something specific. If it's a theme in your business, then it ought to be a theme in your financial statements. So how do you describe what the business has been doing? What do you want your customers, your suppliers, your investors to know about your business? Is it to do with the way that you've been trying to drive down the running costs of your fleet of vehicles, or perhaps providing incentive to employees through an electric car scheme? Is it about how you are satisfying the requirements of your supply chain, especially if you supply into a sector where sustainability credentials are important? So if there's a push down effect and you're trying to tell a story to customers or prospective customers, you want that echoed in your financial statements too. Is this about green finance and perhaps having ESG-backed loans or funding for energy-efficient assets? Or is it just your response as a business to increased energy costs and the power needs of the business itself, and how you're building some resilience in to the high cost of conventional power sources, particularly after the experience of the last 12 months? So how do you build that into your financial statements if you're not caught by the statutory requirements to report? Well, probably the main place to do it then is in your wider narrative reporting. Who is looking at your accounts? What do you want them to know? Well, think about your narrative report. This is probably your strategic report. For example, what do your principal risks and uncertainties say about how you're managing sustainability threats? What's on your risk register about zero carbon or net zero or sustainability or ESG? You do have a risk register, right? Because those are the sort of things that should be starting to feature on there now. So actually that might be a way to provide the reporting. Even if you're a large company and you're using less than 40,000 kilowatt hours per year of energy and have no statutory requirement to report, what else can you do? Well, another area that you could use is the Section 172 statement, either where you're required to do one statutorily or following a similar sort of reporting to use that as a communication mechanism. Think about what you did during the year and how that matters to your stakeholders. For example, who are your stakeholders? Are they primarily employees who perhaps are most concerned about energy efficient transport or about the emissions and environmental impact of the business, who've perhaps raised challenges for you around waste management or around the ethical investment of their pension fund? Are you thinking about your customers as stakeholders? Again, the impact on their supply chain, but also how you're managing costs in order to avoid raising their costs in turn. If you're, for example, a property investment business, perhaps this is about energy efficiency for your tenants to make sure that they can run their buildings more cost effectively. So they want to know what you're doing about that. And if it's your funders, it might be about the sustainability of your business model, it might be the cost of funding, it might be the funding options. So remember, one of the main headings under Section 172 is to think about the community and the environmental impact of your operations. So how does that get reflected through the business decisions you've made? What would you like to be able to say to the readers of your financial statements about your business? What actions are you taking to back that up? Because if you think about what you'd like to tell them and then take actions accordingly, it means that when you come to your next financial statements, you'll be ready to tell your story. And remember, sustainability reporting isn't about getting brownie points. Readers of accounts are rightly suspicious of greenwashing. It's got to be part of how the business behaves. You can't report what you didn't do. So it's got to be reported, it's got to be rooted in real actions. So when it comes to sustainability reporting, you need to be sincere, you need to be transparent, and you need to make it relevant to the readers of your annual accounts. Thank you.